Housing markets experience cycles of growth and decline, often referred to as booms and busts. For both Australia and the United States, these cycles have defined the economic landscape and deeply affected citizens' lives. Understanding these patterns is essential, not just for investors and policymakers, but also for anyone involved in home ownership or renting. In this video, I'll explain the economic and social drivers behind housing booms and busts, the historical impact of these cycles in Australia and the US, and the ways in which global and local factors influence the housing markets in each country. Number one, defining booms and busts. A boom is a period of rapid growth in housing prices and market activity, while a bust represents a sharp decline in those values and activities. While these cycles' length and intensity vary, booms often lead to increased home values and investment in real estate, only to be followed by a bust where prices fall, construction slows, and economic hardship may follow. Number two, historical context of housing market cycles in Australia and the US. Both Australia and the US have experienced notable booms and busts shaped by similar and differing factors. In the United States, the 2008 housing crisis is perhaps the most widely recognized bust, triggered by risky lending practices and an unsustainable rise in housing prices. The US also saw significant housing volatility during the Great Depression and the post-World War II housing boom, which transformed suburban America. Whereas Australia's housing market has been marked by strong growth since the early 2000s, with property prices in major cities like Sydney and Melbourne climbing rapidly. While Australia largely avoided the worst effects of the 2008 global financial crisis due to stringent banking regulations, it experienced a slowdown in 2017 and fluctuations in the following years. Number three, economic and social drivers of housing cycles. In both countries, interest rates play a critical role in shaping housing markets. Central banks like the Federal Reserve in the US and the Reserve Bank of Australia in Australia adjust interest rates to control inflation and stimulate or cool down the economy. Low interest rates typically make mortgages more affordable, fueling housing demand, while higher rates tend to dampen demand and slow down price increases. In the US, the post-2000s low interest rate environment contributed to the housing boom, which fueled the 2008 crisis. Also, Australia's low interest rates over the past decade have incentivized housing investments, with record low rates in 2020 contributing to a strong surge in prices despite pandemic challenges. Also, credit availability and lending standards are also key drivers of boom and bust. Looser lending practices can increase home ownership, but can also lead to unsustainable debt levels and a potential market collapse. In the United States, the subprime mortgage crisis of 2008 demonstrated the dangers of excessive risk-taking in lending, with no-doc loans and adjustable rate mortgages leading many homeowners into foreclosure when rates adjusted. In Australia, the Australian Prudential Regulation Authority, or APRA, has imposed strict lending rules, aiming to prevent the kind of credit-driven boom and bust seen in the US. Still, high debt levels remain a concern, especially in Sydney and Melbourne, and now almost all parts of the country are experiencing affordable housing becoming increasingly scarce. Also, demographic factors such as population growth, immigration, and urbanization drive housing demand in both the US and Australia. During booms, speculative investments often grows as people anticipate rising prices. This behavior was evident in both the 2000s housing bubble in the US and in the Australian housing market during periods of significant appreciation. Number four, effects of booms and busts on the housing market. Booms and busts profoundly affect various aspects of the economy, society, and individual lives in both countries. As housing prices rise during booms, affordability becomes a challenge, particularly in cities where prices outpace wage growth. In Australia, housing affordability has become a pressing issue, with average home prices in cities often exceeding median income levels, leading to increased borrowing and household debt. And in the United States, while home prices in urban hubs have soared, there is more regional variation, with affordable housing options often found in smaller cities or rural areas. Booms can stimulate the economy by creating jobs in construction and related related industries. However, busts can have recessionary effects as housing related jobs decline and consumer wealth shrinks due to falling home values. The US economy was hit hard in the wake of the 2008 housing crash, which led to widespread job losses and a financial sector bailout. In contrast, Australia managed to avoid a similar collapse during the GFC, but subsequent downturns in its housing market have led to concerns over economic vulnerability. The social implications of boom and bust are significant as they influence who can afford to buy homes and where people can live. In Australia, home ownership has become challenging for younger Australians, with high prices locking many out of the market and increasing reliance on rental housing. And in the United States, while affordable options exist in less densely populated areas, housing inequality has become an issue, especially in high demand urban areas. Number 5, global versus local booms and busts. Both countries are affected by global economic trends such as interest rates and trade conditions. However, the local dynamics of housing markets like regional growth and specific economic policies mean that local factors often determine the timing and severity of housing cycles. Number 6, learning from past booms and busts. Reflecting on past cycles often insights into strategies that can help manage future housing volatility. Policymakers and financial institutions in both countries have tried various approaches, from stricter lending standards to regulatory oversight of housing markets. In the United States, post-2008 reforms such as the Dodd-Frank Act aim to create safeguards against risky lending and speculative behaviour. And in Australia, APRA and the RBA have implemented measures to regulate the flow of credit and monitor household debt levels, balancing the desire for economic growth with the need to prevent unsustainable housing bubbles. Housing markets in both Australia and the United States have been marked by cycles of rapid growth and steep decline, influenced by bank lending, speculative buying, as well as economic and social factors. These cycles underscore the challenges and risks associated with housing investments and the importance of looking at the single tax system by removing income and business taxes and replacing it with single land value tax, which taxes people on the value of land, not the inherent building or structures on that land. This will improve productivity while maintaining a sustainable revenue model for public services for all of society. Understanding the patterns and drivers of booms and busts is foundational for predicting future trends. This brings us to the concept of the 18.6-year land cycle, a theory suggesting that these market fluctuations follow a predictable rhythm. In part 2 of this series, we'll explore the history and implications of this cycle for housing markets in both Australia and the United States. So stay tuned for next week's video as I walk you through the predictable nature of land cycles.